Dear ladies and gentlemen, welcome this morning to our session organized by MIPIM and Immobilien Manager. The title of this panel fits to this year's country of honor, which is Germany. As you all know, the title is More Than Core, What International Investors Are Looking For in Germany. As we all know, Germany's economy is still more or less resilient and weathers the consequences of the euro crisis quite well or better than others. And probably this is the main factor that makes German real estate markets more attractive to foreign investors than they have been before. You can see this in numbers. In 2011, the investment volume in real estate in Germany rose by 20%, and 1/3 of this came from outside, from international investors. If you look at the portfolio side, 2/3 of all portfolio deals were made by international investors. This is not a boom in our perspective, but it is a positive trend. And polls show that this will go on because many investors favor Germany, if they favor any Europe country at all, for their investments. And they favor core, like everywhere else. Core is in favor, and this means that prices for core products have risen. And today we want to discuss if this drives investors into a core plus, added value, opportunistic issues, or whatever. And for this, I heartily welcome my partners in this panel. I'm proud to welcome Michael Cooper, Managing Partner of Dundee Real Estate Asset Management. Welcome, Michael. And then on the right side, Ulrich Höller, CEO of DIC Assets AG, Fabian Klinger, Managing Director of Aberdeen Immobilien KAG, and last but not least, Matthias Leube, Head of Real Estate Germany of AXA Real Estate. My name is Christoph Hadebusch. I'm Editor-in-Chief of the German real estate magazine Immobilien Manager. Michael, to start with you, Canada is a rising star among the international investors in Germany. If you look at the list, in 2010, Canadian investors weren't among the top 10 of international investment. In 2011, they are number 3. So a very quick rise. Your first international REITs did a part of that by investing more than 700 million euro in Germany for the portfolio. Why did Canadian investors discover their love to German real estate so suddenly?
Love is a bit strong. I think Canadians like German real estate. In Canada, it's a relatively small country, but we have a crisis in terms of people trying to pay for their retirement, whether it's individuals or pension funds. There's not sufficient real estate for the capital that we have, so the capital's spreading out. The pension funds led, and a lot of pension funds have invested all over the world. And I think the diversification is desirable, plus the variety of properties. We created a specific vehicle, a public company, to raise money, we thought, from retail investors, independent advisors and retail investors to invest in this initial portfolio and invest around the world. It was successful in raising capital, and also it's a little surprising how many institutions wanted to invest as well. But I think the real interest is Canada has been doing better and better, and this is the first time you can sell a building in Canada at a lower yield and buy a building in Germany at a higher yield. And who knows what the future's like, but if the future's anything like what it's been, it'll get back to normal one day, and there'll be an opportunity to get good income and then some capital appreciation.
Thank you. Matthias, you present a French investment manager in Germany. How is the Paris view on Germany?
I would say I'm representing an international investment manager in Germany with its base in Paris. Our international team is comprising of a number of people across Europe. So I think generally the view on Germany is very solid. Germany is one of our 4 pillars in Europe. We believe that Germany in 2012 and 2013 will be very interesting for a lot of international capital coming into Germany, but also for German investors investing in Germany, investing in German products.
Yeah, Ulrich, you have a lot of experience investing and developing in Germany. You had a lot of experience as partner of international investors. Is what we see now just a small wave? Is optimism justified, or is Germany just the one-eyed king among the blind in Europe?
No, I think from the international perspective, Germany is always there. So Germany is core, and that's what. And Germany is on the other way sometimes boring core for international investors. That's what I learned over the last 15 years. But it's always there. It's an important and big market in Europe. And so if people think about Europe, surely these days, especially about Germany. And so therefore, we were always concentrated. We are pure play, German commercial investment company. So we were always concentrated on Germany because based on our philosophy, all business is local. And Germany is more local than other markets. It's the most diversified market in Europe. So you cannot compare it with France, driven by Paris, with UK, driven by London. So we have 5 or 7 top cities, and we have a lot of interesting B cities out of the German federalism. So therefore, I think Germany is always attractive for international investors, but it's a difficult market also for international investors.
It's a difficult market, Fabian. Aberdeen has quite mixed experiences in Germany with good investments and the open-ended fund story that doesn't went so well. Are the lessons learned for international investors in general from the past?
Yes, the reasons of the open-ended funds, I think that are other reasons. But what we see is that institutional investors, foreign investors, they are looking for stable yields and lower volatility, and the German market is a stable market. The economic data are very good. It's a stable market with stable yields, it's a stable rents, and there are existing core assets. The typical investment style is core. 60% are core transactions at the moment, or 65%. We see that especially secondary cities will be more attractive in the future, especially also for foreign investors, because the opportunity to get a much more higher yield combined with a low volatility, it's a reason to invest there. The problem is then for foreign investors to find the right asset manager, the right fund manager, because that's difficult to enter in a market which foreign investors don't know, so they need here a service provider, and so that's also our strategy, to provide these services to foreign investors. And Aberdeen is a European player, and many investors, they are looking for opportunities here in Germany.
Michael, I just mentioned your investment in Germany as a post-portfolio. Is this regarded as core? And what is your core definition?
We tend to use words like institutional versus non-institutional. And our experience is when we own an asset, it's not institutional. And when we sell it to an institution, it's institutional. And when we buy it back, it's non-institutional. And I think core is much the same, that it's whatever people say it is. So we don't really focus too much on that. I would think that the portfolio that we acquired is a place to get started. It's a large portfolio, it has a high yield, it's got a good tenant, it's very diverse, and that got us in business. From here, I think the idea is to go with much more popular real estate, office buildings in the B cities and in some of the A cities. The current interest rate environment combined with, as you say, core assets generates a pretty desirable return. And we don't think we have to get too exotic. We can buy plain vanilla, good quality real estate and generate the returns our investors want.
But you will invest in B cities, as you said, secondary cities. But here's this fits to what you said in an interview with Immobilien Manager. You expect more core plus investments in the second half of the year. What makes you think that?
I think we will see over time now a repricing, particularly in the core plus segment. I think so far the seller and buyer assumptions in terms of pricing has not really gotten to a point where we see significant amount of transactions. As said before, most of the transactions are in the core segment. But I think the core plus segment will reprice now over time and will provide quite attractive opportunities, also in A cities, I think. Yeah, so certainly, and we had the discussion prior to the session here. Certainly, understanding Germany is quite difficult or complex, I would say, for international investors. Because yesterday evening I was, for example, sitting next to a Korean investor saying to me, "Shall I invest in Frankfurt?" And I said, "It's not that easy to say, shall I invest in Paris or shall I invest in London, for example." The situation is you really need to understand the opportunity, and it could be in in A city or it could be in an B city, really.
Yeah, which makes it hard to understand this market. But we refer to this later. First, Ulrich, I would refer to the crucial role of the banks. You said prices will come down if vendors don't go down with their prices, and banks won't finance with a higher LTV. There wouldn't be any growth in investment, will it?
I don't see the situation with the banks such negative. Surely there will be a distressed portion in the market, but also here, especially for new acquisitions, there is still throughout the German diversification a market for investors, also for international investors, maybe in partnership with Germans. Some of them learned now, because through the diversification they can also finance diversified with regional banks, etc., who fill up the lack these days up to special sizes, to 20, 30 million euro acquisitions. So therefore, I don't see that there's pricing coming down. I see more that there is a natural way that this niche of core will spreading up to core plus value add, as it did often over the last 20 years. So that will happen in the next 1 or 2 years. I think the next 18 to 24 months that investors will see maybe a core plus value add asset in Germany is the same as a core asset as in international markets. And it is like that, definitely. Surely you have, if you think in exit scenarios, etc., you are a little bit more limited, but you have also less volatility. And again, if you understand the market, or if you have partners who understand the market, also these regional markets, the secondary cities, there are a lot of investors. Again, Germany is diversified not only because of macro location, therefore is also diversified with the players, the investors, the developers, etc., which are much more local. Again, real estate is local business, and therefore that's the German market.
That's the German market with a lot of chances, a lot of risks, Fabian. Will this fact that banks might force owners to sell more product, some open-ended funds are forced to sell more product, this must have an effect on
yes,
prices.
but the funds have not to sell the properties because they get no loan. So that's not the reason. I think the bank situation, I think the bank situation in Germany is very good. So it's easy to find, or not easy, but you can find an excellent financing for a core asset. The problem we have at the moment is more the financing of core plus and value add assets. So because investors are looking for core, but banks are always are also looking for core. But what I see is that at the end, the banks need also a yield which is attractive at the end. And so if they want to make new business, they have to accept at the end also to finance also core plus assets and value add assets first. Secondly, we see also other players which will come to which will enter the market. Pension fund, insurance companies, they are thinking about acting as a debt provider because they see it's an attractive yield they can get, and so I think they will enter the market as well. So the financing situation is difficult for value add assets, yes, but we think, or I think, there is a solution in the future, and perhaps the margins will increase. But we have also historically low interest levels, so that the all-in yield you have at the end is not so a big problem. If you have a margin of 300 or 400 basis points with an interest level of 1.5%, so you have at the end all-in rate of 5%, and 3 years, 4 years ago, that was normal for value add as well. So you should also see the whole amount of interest rates here.
Yeah. You mentioned other players, Matthias. The insurance companies show more and more interest for the debt side. AXA launched a huge fund for debt fund. Others go there, do that directly, and mainly core, as far as I understood. Will this drive banks into more riskier businesses?
I don't think so. I think, and just explaining what we've done, we've established a debt fund initially with 2.5 billion, focusing on the main countries in Europe. This is now open also to third-party investors. We have just gotten a top-up of another 2 billion. I think this core senior debt segment is quite attractive, and we are finding that this provides quite a good ratio between risk and premium for the investors. In terms of the financing and banking market, I think if you're referring whether we have a liquidity issue in Germany or elsewhere, I think in Germany particularly, as a lot of banks have retracted from international investments, there's quite a competition in Germany on financing. So I think this is also why we haven't done a debt transaction in Germany yet. I think in that context, finding finance in Germany for core is possible. Finding finance for value add is more difficult. I think we could see that banks are going up the risk curve more than beforehand because of the competition. We haven't seen that so far, but that might be one of the developments going forward.
Yeah. Michael, from your point of view, is finance an issue? We heard many German banks retreated to Germany. British banks did the same.
Financing at a moderate level is an important part of our strategy. We like to use about 50% debt. And for us, we're a new player, so we have to meet the various lenders and develop relationships. And we've been making progress, but maybe it's better than other European markets, but I do think that financing is an issue in the market right now.
Yeah, it's an issue of is the tension growing or easing?
I think it's very slow. So I think it's slow both in terms of the amount of new loans, as well as the amount of time it takes, and other mortgages are expiring. So I think it gets played out. I mean, the good news is that there's new capital coming into the market. So I'm not sure what happens with pricing of the assets, but I think that people are probably going to be looking at using more equity and getting a decent return on their equity and less reliant on debt.
Yeah. But investing is always, from the international base, a question of alternatives. This morning I spoke to an American researcher who said America is coming back. and getting more and more attractive. How is Europe as a whole and all this Euro stuff how is it seen from?
Well, it's very exciting.
That point of view.
You know, this is a continent in huge transition, and you know, generally, the future tends to look a lot like the past, generally, and sometimes it doesn't. And we're very hopeful that this time it looks a lot like the past and isn't very original. But I do think that the U.S. is getting better. I think the whole world's getting better, and it takes time to realize it. So I think that, you know, most of the big issues we have are more political than financial, and they'll get fixed. In the meantime, I think that, you know, there is this issue about how do you get a decent return without taking on too much risk, and real estate's providing that for a lot of people all around the world. And I think we're going to continue to see relatively low interest rates, and I think we'll see a relative competitive environment to buy assets. And I think investors will do relatively well, but I don't think the types of returns that people talked about years ago are what we're going to see going forward when there's not that much growth generally. So I think it's probably going to be safer than people think it is now.
Yeah. But as other regions, Fabian, other regions are growing faster than Europe, like Asia is growing faster, the United States are growing faster right now. Is the window of opportunity for in which Germany is quite attractive, very narrow?
No, I think it's it's a big structural change. I think it'll be open for years.
Yeah, what do you think? Yeah.
No, I think also it's open for years. So because first we see if you see the history also of transaction volumes in Germany, we have a base of domestic players. So you can say 10 billion euros per annum is domestic, and then foreign investors, additional foreign investors. Germany was attractive in 2006, 2007, we saw it, but there was another investment style. We had the core, we had not here the focus on core assets. There was vacancy was trendy, so you got the best price if you had a lot of vacancy. So I think the investors learned about that. So that's also, I think, a reason because of changing this investment style now for foreign investors, and core assets are existing in Germany, and it's not a window now for the next month or half a year to buy in Germany. Of course, if you see the retail or office in really a location, so you can think that the prices are high, of course, so they can also increase. But then the trend to go more in the secondary cities, and then the definition is also what is core. So I think a really good quality property in a location in a B city is also a core property at the end. And these properties, I think, this should be attractive also the next years. And we should also not forget the residential market, so they are also growing in Germany. There are also opportunities here now to buy, because what we see is that the trend is here that we have a decrease of population, of course, but we have also the development that people are moving from the country into the towns, into the big towns, and here families are looking on, people are looking for good buildings, properties where they can live.
Yeah. But A buildings in B cities, Ulrich, may be a good choice, but maybe hard to explain. If you take the role of a vendor, are international investors in general open to arguments like this?
They have to be open. They have to be open. They will learn it at the end. You know. Again, we had, if you see international investors coming into Germany on a broad range, beginning in 2004, starting with the residential, 2005, started slowly the office markets, 2006, 2007, yeah, and then it ends up with Bear Stearns and later Lehman, etc., and the finance crisis. So I think some of them had learned their lessons, or others have learned the lessons from the one who failed. And definitely coming over, taking a big picture view in Germany doesn't work throughout. Okay, I repeat myself, throughout this diversification. But definitely, they are convinced, the people I'm talking to are definitely convinced to good B cities, to secondary cities. That's a range of, I would say, 20 cities behind the top 7. But there is another 50 interesting cities which are related to universities, have a good infrastructure, are in growing areas, etc. I haven't seen that international investors aren't negative, and knowing that most of them requesting higher returns. And I'm not talking about 20% IRR, but I'm talking about equity returns of, let's say, starting double digit. You have to be in a secondary market, or you have to be in a development, etc. That definitely doesn't work with core assets in the top cities in Germany. So therefore, that was the background of my answer. There have to be, and there will be. So I think they are open to that, and maybe they are looking much more selective today. They are looking much more. Do we have a partner there? And that partner doesn't mean always joint venture partner. It could be also that you have organizations like you just created. I think that's the main angle to get entrance in these markets. And therefore, again, international investors are also attractive for the German players, not only to sell something to them, also in partnerships, knowing that for German players the equity requests, etc., are much higher than in the past. That the lack of financing, surely there's a lack of financing, also that it's still working. It's getting more difficult to get the entrance, so there can be definitely a win-win situation.
Yeah. Michael, you invested in B cities also by buying this portfolio. How do you hedge the risk?
Buying a lot of B cities. No. I like that. I think that the original portfolio we acquired has a long-term lease with a large tenant, and it really is just an entrance into the country. One of the things that's unique about our company is the principals of the business own 25% of it. And that means that the other investors are pretty comfortable that the decisions we make apply to us as well as to them. And it gives us a lot of discretion. So, you know, we think that one of the things that makes a public company valuable is the ability to diversify its own portfolio and get a valuation based on the total portfolio, not on each individual asset. And that tends to benefit more from not core assets. The core assets usually have the highest value on their own. So for us, what we'll look at is, and again with B's and A and A's, it depends, but like Hanover, we think that's a decent city. I think there's a number of cities like that that are quite desirable, that you know, they have growth in the cities, they have a dynamic population, and where we can find excellent quality buildings in those markets, we're very pleased to own great buildings there.
Ulrich said 50 cities. There's a lot to explain for asset managers, and 70, all in all it's, okay, 70 cities.
77.
77, even, it's getting more and more consulting to be done. Matthias, what Ulrich also said is that co-investment might be a good strategy because international investors look for co-investors. Is this a fact?
Absolutely, and we are seeing that investors talking to us are very interested that we co-invest with them when we do sizable transaction in Germany. I think for the investors it has the advantage that they basically go with an asset manager or investment manager that basically understands the market on the other side, provides a significant percentage into the transaction and basically shares the risk and also obviously the returns of such an investment. I think it's a very good strategy, starting with a number of the sovereign wealth funds are exactly doing that. They are setting up separate mandates, for example, and investing with asset managers in specific countries. and mainly they are seeking to co-invest with this investment asset manager in those countries.
Sovereign wealth funds, keyword to my questions to you, Fabian. Which investor types, investment styles do we see now? Which will we see in the second half of the year?
Difficult question, but okay, the investment types, I think we see really core or core plus. If value add could be interesting, it depends, of course, of refinancing also, or it's possible. Perhaps what we'll see is that the LTV will decrease. So now it's difficult to have a financing of 60–70% for value add. You will not get that. At the end, you will have a lower leverage here. But I think we go more in the direction core plus, but in the sense that the secondary cities will come more. So here, good properties with good tenant qualities in smaller cities, secondary cities. So I think you can define it as a core investor, but it's core or core plus investment, and I think we will see it within the next year.
So there won't be any opportunistic strategies we're going to see, probably because of the lack of leverage.
Okay, the lack of leverage is there, of course. No, I don't think so, that opportunistic will come within the next year. Okay, we'll see many CMBS financings will come within the next 2–3 years. So perhaps there could be pressure on some portfolios that they have to sell at the end. But we'll see. But I think also for this CMBS there could be some refinancings, but on a lower level, and that could be the reason then that the transaction side will increase.
Let's finally have a look on the different asset types. Matthias, the flavor of the day is retail still. Most of investments went into the retail sector. Office lost ground a lot. This has a reason. The total returns of office proved to be not that attractive compared to retail, even compared to residential assets. Will this remain, or can office assets turn the tide?
I think a lot of investors went into retail because they are thinking this is the basically more safer haven for them in this environment. I think generally office is something you can invest in Germany. I think it has to do with the stability of the country. The question is, what kind of office you are investing in terms of location, in terms of, setup of the building, and also in terms of understanding the market there. I think purely investing in retail is not a strategy that will last going forward, because there is quite a lack of that product. I believe that people will continue to look at other asset classes, offices, logistics, and also hotels.
Michael, do you have any preference for a specific asset class?
We generally prefer office, and within office, we do like multi-tenant buildings where they can continue to prove their value with exposure to the market and get some rental rate increases. To the extent that we can buy them with below market rents, that's good. It's hard to do in Germany. A lot of the buildings seem to be fully let. But we do like office, and we prefer not to have exposure to one tenant, which is what we're diversifying away from now.
By the way, you, with the portfolio, you bought the management also?
We didn't buy anybody.
I know, but the managing company.
And
now you hired 2 more people, 2 more Germans to do things on the ground there.
You are a journalist. Yes, that's true. We hired 2 more people.
You sent me the notes, so that's why I know that. Do you see other institutional investors from abroad doing the same?
You know, our investment vehicle is a self-managed vehicle. So what we build up a team of locals, and we're very involved. It's a very major initiative for our business. It's a huge undertaking. I don't think a lot of pension funds would set up an own management team. They tend to join up with other large institutions or well-known developers. So I don't think you'd see many other Canadian groups coming here and setting up a management team.
So thanks a lot. Maybe we will give you now the opportunity to ask us whatever you want. If you wish a microphone, I'll bring mine to you. So please ask us whatever you want. There's a question over there. The microphone is coming from the other side.
Hi, my name is Pablo Alvaro Gonzalez from Ursus Capital, a small fund manager present in Germany for 6 years. It seems that across the board you're all quite convinced about the office market and its attractiveness. One of the difficulties that I've had when I've analyzed the market in Germany is that the vacancy rate levels for offices are, I find, sometimes quite bothering, I must say. And I have an office in Berlin, and I find it quite shocking to see some buildings, some office buildings that are in very prime areas that haven't been leased for 2 or 3 years, and they're held by some institutional investors. How do you see that holding value and, you know, justifying it as a core investment when there is such situations in the market? And I know that's not just in Berlin, by the way.
Who wants to answer?
Matthias,
go ahead.
I make a start. I think generally, of course, you see, for example, in Frankfurt, a vacancy rate of 15% as an example, yeah, which, as a number, initially you think, you know, this is a problem. No? But if you really look into the numbers in terms of, you know, what is available, what kind of products are really there, what take-up is there, and you see that some buildings get let pretty well, and there you can see that it basically is important to be selective about the assets you own or you select in terms of buying, and through that you can basically enhance the value in that situation. So initially, some of these numbers might look bothering or worrying, but I think if you do the right investment strategy, you can basically achieve quite attractive returns if you are actively in the market and have chosen the right product.
Fabian, then Michael.
Yes, in such markets you should have a different view on the asset. So I think Frankfurt is a good example. Here we have 15% vacancy, and there are assets, office assets, which are vacant, and you will never let lease with properties at the end because there's also a structural vacancy. But so you need a different view, but when we are not talking about core assets. These assets are value-add assets, and the core assets we have in the A locations, and then also in the with a good tenant and a long-term lease contract. That's different. It's also the quality of the building, which is enormous important to be here attractive for investors at the end.
Okay. Michael?
I think obviously to buy buildings that are attractive, that have the ability to provide what tenants need is very important. But we are really in a slow environment now, and it seems logical that leasing would also be slow, that a lot of people have a hard time making big decisions about the future. We're finding that week by week we make a bit of progress. And I think that that's likely the environment that we're going to be living in for a long time, is that the vacancy is an opportunity to make some money. If you buy the building with vacancy and your overall return reflects the cost of carrying that space, it's probably going to be an advantage over time that you get to fill it slowly.
Satisfied with his answers, or?
Well, I guess my question comes more from, if I have a lot of vacancy, unless take-up will increase, however much I want to expose myself into core, at some stage, whether you are at the top of the market or in the B segment, you're going to find some pressure taking place. And I mean, in Germany there's a lot of money, and there is a lot of people who are still building new office buildings, top spec, and I think, you know, there can be a justification to a certain extent to say, look, I've got the best, most adjusted quality to the tenant demand, but if the take-up is not coming over the long term, then what's so core about this market?
There is Matthias?
I think Ulrich, you want to talk about, I mean, Ulrich is just building quite an interesting development in Frankfurt, yeah, so, and maybe he wants to talk about it, but...
No, you have to vote for it, because it's for the MIPIM award, so please vote 50 meters away, Main Tor, Frankfurt. No, but yes, you know, the developments in Germany, you just see. Also, if there's some, they are spec, and I think they are less spec these days, because therefore you have to use 100% equity to get something spec. It is on one hand side a request for sustainability, but on the other side, and Frankfurt is the example everybody of my colleagues mentioned just, it has around 13–15% vacancy, but there is still some development, also ours, the Main Tor, under development, and we have a huge request and demand of tenants. If you analyze these market, Frankfurt, you would say, or for Germany, 50% is super high. We have never seen before, by the way, 50% in Germany, which is normal in the US. You would say never there should be the development, also that there is no additional take-up from outside coming in. But there is a huge request for high-quality assets. There's a request for sustainability. You see a lot of old buildings, so you see a lot of movement. Yeah, you have seen in Frankfurt a lot of movement in the better years, 10 years ago, when rents rise up to 50 euro per square meter in the city center. The companies go, the tenants go to the suburbs, and now they're coming back. Surely there is a movement, but you see a lot of quality or bad quality assets in especially Frankfurt, so therefore definitely all these new buildings which are such these days under development will fill up definitely in the next 3–4 years for good rents, for higher rents than you have seen today, and that's something where you have to go deeper in. Surely that meant at the end that failed developments 10 years ago in the suburbs, which were done to deliver something to these tenants, have to reconvert, have to demolish, whatever, maybe in residential, that's another issue. But that's something you should know, and especially Frankfurt is a good example to understand this market and how difficult it is that the first view is maybe the wrong one you would take.
There's a German expression says Sockelleerstand, means like basic vacancy. This is amount of vacancy that is growing with each cycle. It's building up from 2000 to now even more, but it's concentrated in peripheral and secondary locations and older buildings, less quality and so on. But this is what you see in the numbers, that a growing amount of old buildings in bad locations have no real chance to attract new people. Satisfied now, or maybe other questions? He's not really satisfied, I see. Maybe
I'm sorry, it's just basic economic logic, supply and demand. If you don't see take-up coming up, you can play the obsolescence game but among the top stock, but we're talking about investment in core. Yeah. And at some stage, core will be affected by that. If I am looking at my investors, they want to invest maybe for 10 years. That's a very German approach, a long-term approach. Yeah. You know, they're going to ask me 10 years down the line, am I going to still have 100 euros where I put 100, or will I have 80?
I think we answered it because we said we have to go into the deep. There is a certain risk. Not everything that is called core proved to be core in the past. We all know that. And there is a certain risk, and there is no risk-free asset class anymore, I think, and core isn't risk-free. If anybody thinks that, it's wrong, I think.
I think it's pretty wonderful if you can tell your investors what return they'll have in 10 years. That's something that's pretty difficult. And I think that the real question becomes, you know, how much growth will there be, and will that lead to more take-up? If there isn't a lot of growth, then it's not just the office building. I don't think the retail buildings will be doing so well if there's high unemployment and very little income. And I'm not sure the computer consulting companies that are public, that you buy their shares, that they're going to be up. So I think the real question is, when you look at the asset, is it a good storehouse of value? Now, your position seems to be that we're going to have less tenants, that spaces are going to remain vacant, or vacancies are going to increase. And if that's what you believe, then it may not be good for you to invest in office buildings.
But there is growth, so I don't know what we're talking about. You see that definitely over the last 2 years, the vacancy rates went down, also in Frankfurt. They were coming up from 18, and now they are 17, and now around 13, 14. And that's similar in the other top 5, top 7 cities. So again, there was growth, maybe not the biggest one. So my answer to yours, if you tell your investors what are my 100 euros will be worse in 10 years' time. If you do a super core investment these days, yes, maybe it's less than 100 because it's partially overpriced. If you're going maybe a little bit more the real estate way, looking a little bit more for a secondary market, a good asset with the pricing of today, that's a real chance, realistic chance that it will be 110 and 120.
Are there any more questions? Obviously not. Hope we. There's a question. One more.
Good morning. Klaus Uckelmann is the name. I'm a realtor from Düsseldorf, and I would like to answer one to your questions because I got by fortune. I got a commercial property in Frankfurt for selling. It was about 4,000 square meter from the 70s, and I mean I had the experience. It was in the internet for about 7 to 8 months, and I got, I think, 3 or 4 requests to sell it. It was about 4,000 square meters, and they wanted to sell it for about 3 million euro. And well, what's happening right now is there's only one guy who saw the property and then made an offer to rent it. Yeah. So the other requests that I saw were in the direction of well, not using it for commercial, as a commercial property, but for residential property, to convert it. And this is what I see in Frankfurt that makes sense in this time, because there's much more request for residential properties than for commercial, especially when they are old and they need to be refurbished totally. So this is what I experience in Frankfurt. But I have a different question. I'm specialized more in residential properties over Germany, and I would like to know what you recommend in terms of financing for international investors, because I'm running into these problems. There's Basel III coming, and much more request for cash in terms of financing these buildings. So I would like to know what you recommend, how we can help these guys from abroad to get their financing done. Yeah.
Yes, that's a good question. Okay, the first question is you are talking about debt financing. I think not equity. So I think there are many banks which are doing residential financing, especially if the residential quality is very good. So if you buy, for instance, you mentioned it, a good new development in Frankfurt in a good location, you will get a very good price from the banks, and also the kind of insurance companies and pension funds are also looking for such financings. Okay, how can we help foreign investors? So, I think the financer, the debt institutes are German, so these German banks provides the money at the end, so they can go to the banks directly, or they can act with a service provider, with a local asset manager or fund manager, and then they will get a very good condition at the end.
Okay. More questions? There will be time for at least one more question, but obviously we said enough, so thank you very much for listening to us. Thank you very much for discussing. Wish you all a very, very successful fair and better weather than yesterday, and have a good MIPIM. Thank you very much.